Well, hello then everyone, and just a quick update from us on the goings on across markets this week. We had a pretty choppy week. Not in terms of actual choppiness like sideways. It's just been it was pretty one directional to begin the week, and then pretty one directional to end the week. Now we'll just start on Monday. We'll have a quick look just where we started this week. Just look at this ISM manufacturing PMI. You can see the consensus figure 52.2. We came in actually at 50.9. So there was a bit of positivity in markets, or certainly positivity around risk sentiment, that this would then cause, is proof of a slowing economy in the US, and then means that the Fed are more likely to curb the pace of their interest rate hikes. Now that has then been backtracked then over the course of this week, but we'll have a speak about that as we come down to it in a minute. As we come across to Tuesday with the RBA, we were expecting a 50 basis point interest rate hike on Tuesday. That's not what we got. We got a 25 basis point hike. Now, as we were expecting 50, the fact that it comes in 25 is slightly dovish, definitely slightly dovish, and that is then seen as a sign of slowing the pace of tightening, right? They're going to remain data dependent going forward, which is the script that all the central banks seem to be sticking to. But the reason why that was significant, not because the RBA have much of an influence across the global economy, but it was going in line with that potential possibility of central banks curbing the pace of interest rate hikes or slowing the pace of tightening. Now that was then across markets. It was slightly positive then across the board over the course of Monday and Tuesday. But as we started to get into Wednesday, and then certainly into Thursday and Friday, things started to turn around again. We come down to a couple of data points down on Wednesday. Not really much information to go off of that. We just had what we had is Feds Daily came out and said that they will not slow the pace of tightening like the RBA, and poured cold water on those thoughts that maybe the Fed would follow suit. So we pretty strongly met with resistance that thought process was, and then the markets have turned around since then. We'll come across then to non-farm payrolls, which we had out today, and that further that further shows the kind of problems. I mean, the continuation of interest rate hikes is probably going to have to remain at the speed that they are. We can see the non-farm payroll slightly above consensus, but that was not the main focus of attention at today's release at 1:30. We can see this unemployment rate actually ticked down from 3.7 down to 3.5. Now, what that does is the fact that less people are unemployed, right? The fact that less people are unemployed and more people are in jobs, it gives the Fed a little more room to continue hiking interest rates, right? As we come across the next week, there are inflation figures out next week, which we will speak about again when we get back to it in a minute. But just one thing that I forgot to gloss over, not on this calendar, so I don't know why, it seems to be medium impact on my trading economics calendar, but we did have the Kiwi Central Bank, the RBNZ, the Reserve Bank of New Zealand, did come out and raise interest rates by 50 basis points from 3 up to 3.5. Again, stuck to the same script. They're going to remain to be data dependent going forward, and getting inflation under control and all that good stuff that the central banks are continuously telling us. So not much to be seen there with the RBNZ. I mean, say not much to be seen. It's a 50 basis point hike. That's just the world we are in at the moment. A couple of years ago, a 50 basis point hike would be a very rare occurrence. Now they are just pretty normal, 50, 75, even 100 in some cases. So this is not normal market conditions, not normal interest rate hikes. We just got to keep that in mind as we move on forward. But we'll flick across to the charts and we'll have a quick look at some charts. Now we'll see a lot of focus was on this 10-year yield this week, right? We can see all this bull run, then interest rates rising across the across the yield curve. But just look specifically at this 10-year yield, over the last number of months, last couple of months, this has risen pretty aggressively higher, and also over the last back since July 2020, this has just been on a one-way train higher, and that we did have a bit of a pullback in that, and over the course of back end of last week, start of this week, and that did prove give some respite to markets. Now we could see risk assets moving higher, things like your S&P. Couple that with the fact that the dollar was moving lower, we were pretty one directional over the course of Monday and Tuesday. This kept pushing lower, which then provided some relief to indices. It provided some relief to the dollar. The dollar pulled back as well. And that was mainly due to this chart here. But then we got Fed's daily out on Wednesday, pouring cold water on those thoughts that they may slow down the pace of tightening. And that has completely just blown that thought process out the water. And now we've come into the back end of this week. These moves have then turned around and continued, and the trends have continued higher. We can see the S&P 500 over here, pushing back lower. It is in line with the higher time frame trend, and now continues to push lower into the back end of this week and into the close. You can see euro dollar pushing lower, cable pushing lower as well. Number of the dollar pairs showing again dollar strength, which is back in line with those higher time frame trends, and then goes in line with Fed's daily pushing back on the potential thoughts that the Fed were going to slow the pace of tightening, which does not seem like it is on the cards just yet. Another interesting move though was oil. If we have a quick look at oil now, there was reports last weekend, over the weekend, I think Saturday last week, could have been Sunday when I was reading it, but I think Saturday, there was reports of OPEC cutting oil production by 1 million barrels per day. But what we've actually got over the course of this week was OPEC coming out and saying that they were going to cut oil production by 2 million barrels per day starting from November. Now, Saudi Arabia's oil minister has come out and said that the oil production from these countries is under target levels anyway, so that the actual production cuts are more likely to be 1 million to 1.1 million from what they are today, and that is then to start in November. What that does is, if you remove supply from oil, or supply of oil, from the markets, you remove supply of something. If supply of something decreases, the price then goes up, and we've seen an over 12% gain so far this week across oil, and that has been a pretty one directional week across oil. And with those 2 million barrels per day cuts, again, if you listen to Saudi Arabia, they say 1 to 1.1 million. They do benefit from higher oil prices, so why wouldn't they want higher oil prices? If you were them, or if I was them, I'd probably want the same thing. But the prices of oil then rising, price of oil rising is negative for the global economy if these things cost more. I mean, oil, it's not sustainable. Oil above $100 a barrel. That is not sustainable. But with OPEC cutting oil production, I mean, they can make more cash for themselves, but they say it's needed to cope with global demand where it is at the moment. But rising oil prices, continuation of the prior uptrend, as you can see all the way back here, massive uptrend. We have had a solid pullback, but we are now breaking through the last confirmed lower high. So we're going to go on for technical basis on this. That is then a breach of the downtrend, the longer term downtrend, and you'd start to look a bit more positive from here on out. But again, remains to be seen how that plays out into next week. But with a 2 million barrels per day cut from November, that's likely to cause increased upside across oil. But is it as easy as that to trade? We probably would expect a bit of a dip at some point. So I think we're going to have to wait for a little bit of a pullback to go add on dips to get back into this move higher. But I still think the bias for oil is pointed higher after the developments over the course of this week. We'll just have a quick flick back to the calendar. We'll go back to next week, and what is important next week, I think, are these figures here. We got inflation figures out of the US next week. Now, if we go back to the start of this week and we just think about what markets were anticipating or hoping for, that the Fed would dial back the pace of their interest rate hikes. That's what markets thought on Monday. Then get the RBA, who did slow the pace of tightening, and that was then further fueled that fire. Coupled that with the non-manufacturing PMI out on Monday, there was a bunch of things suggesting that the Fed may potentially look to slow the pace of tightening. Again, on Wednesday, that was poured cold water on by Fed's daily, as I've already mentioned. And then into Friday of this week, about an hour ago, well, it's probably about an hour and a half ago now, I don't know exactly what the time is, but with NFP, we didn't get much off that, but with the unemployment rate ticking down with a minus 0.2% in the rate of unemployment in the country of America, that gives the Fed a little bit more room to raise interest rates. But if we look at this, then that brings us into next week, and falling unemployment rate causes the Fed to be able to hike interest rates more. That is negative for stocks, and stocks have pointed lower off the back of that today. You couple that with the fact that we're expecting strong inflation into next week. If I just get the medium impact data releases up and we come back over to Thursday and look at the core inflation, the month-over-month figure for core inflation, we're still expecting a 0.5% increase, right? That's what consensus says, and what that is a 6% increase in the yearly figure in inflation. So inflation still continues to move higher, past what the central banks would be hoping for. So that just shows again that interest rate hikes continue to be needed as inflation continues to spiral out of control. So the core inflation rate is supposed to tick up by 0.2% year over year. The total inflation rate minus slightly, but I think the core inflation rate over the month of September is probably what we need to look at, 0.5%. If we can if we get above that, that should cause continuation of the downside in stocks, should cause continuation of the upside in the dollar. And I think into next week, off the back of weak unemployment figures today, a minus 0.2 change in the unemployment rate, that's short equities off the back of that, and into a strong inflation print next week. I think staying short equities into Thursday does not seem like a bad decision. You've then got other things. If you just have a quick flick across, you've got the minutes out on Wednesday. You've got a few different other releases. If you look a little bit closer to home, I'll just flick it back to the high impact, a little bit closer to home. You've got the claimant count change, the unemployment rate, labour market figures out of the UK on Tuesday. Couple that with GDP then on Wednesday. We have a little bit going on next week in terms of the UK. We're expecting a contraction of the economy in the month of August in the UK, and we are also expecting not much of a change in terms of unemployment. So if you can match, if you get weak GDP figures, weak labour market figures out of the UK next week, if you can couple that with strong inflation figures into next week, that should prove probably supportive for shorts on sterling and also staying short indices into next week, but we will have to cross that bridge when it comes to it. That is it from me then, folks. That is it for another week of trading. Pretty up and down week of trading. Should be some opportunities next week into that CPI print next Thursday, but I think probably off the back of some weak labour market figures, probably short cable might be an option on Tuesday, but I definitely think short equities or staying short equities if you're already short into next Thursday is probably the way to play it. But that's it for me then, folks. I'm going to wrap it up there for this week. Have a good weekend. Do recharge the battery, and we will be back next week for another week of trading. Thank you.